Hello everyone, welcome back to the channel Vadapalli Technologies, your wealth creator. Today we will see about systematic investment planning. So the word systematic investment planning in the recent days gained in importance towards the investments into the mutual funds, investment into the shares, which means equities, and investments into the exchange traded funds. And within the exchange traded funds, we seeing about bond markets, we are seeing about indices products, we are seeing about international indices, right, etc, etc, etc. Why this term actually which gained importance? The systematic investment planning, right? There is the other word also, the systematic withdrawal plan. Once you are investing into the markets, means whether it may be primary market, whether it may be secondary market, you do know the systematic withdrawal plan also. Once you are invested, means somewhere you need to make the cash out of that investment, so that is withdrawal. Suppose you don't know the withdrawal, so it is again a problematic. So I will make another video regarding the systematic withdrawal plan. Today specifically, let me talk about systematic investment plan. So the systematic investment plan or planning means you are going to invest in the stock market or market related instruments, financial instruments, as I said, mutual fund, traded funds, exchange traded funds, into some more types. Let me in detail talk three types of systematic investment plans in these by using different type of financial instruments. First, let me talk about equities, SIP in equities, right? So the investment on a monthly or a quarterly or yearly, according to your choice, you may invest into the different type of equities, share stocks. Let's take example of Reliance Industries Limited, or Tata Motors Limited, or Tata Consultancy Services Limited. In pharma sector, Dr. Reddy's. So in Infosys in IT sector, like that, these are the blue chip stocks, and there are mid cap stocks, and there are multi cap stocks. There are different type of stocks. You want to invest in different type of portfolios. So by using a monthly 1,000 rupees amount, or 2,000 rupees amount, or 3,000 rupees amount, 5,000, 10,000, and so on, according to your choice, according to your monthly income, you may choose either an amount or a value of the quantity of the stock, right? So you choose for your 1,000, for your 2,000, for your amount, basically how many shares you will get systematically. So then you buy monthly and you forget it for long time. So then the wealth will create out of the systematic investment plan. See, you are investing the lump sum amount, means there is a probability of you are buying at the higher price and the share price may come down and you may lose it. But in a systematic investment plan, there is a concept called averaging. So you will buy in higher market price also, you will buy lower market price also, you will buy in average market price also. Completely your investment with will be there with the average price. So in a long term, automatically the share prices need to go up. Then your systematic investment in plan will work out for you by creating some multi-bagger or some wealth. Basically, the advantage of the systematic plan investment in equities is averaging, rupee cost averaging, the concept called as. Once you averaging the share price, so then in a long run, the indices will go up. According to the indices, the share prices will go up. Of course, there is a high chance of probability you will make the money in by using SIP method in equities. And also you can diversify your portfolios across the sectors like pharma sector and IT sector and oil and gas sector and services sector, FMCG sector, real estate sector, etc, etc is concerned. So basically, so compared to the lump sum investment, the systematic investment plan which works out, I explained very categorically. The second type of systematic investment plan is in mutual funds. Actually, lot of broking houses which is nowadays which came up with the SIPs in mutual funds. The mutual funds or the funds investment schemes, collective investment, right, which collected by the fund manager, right, by the asset management companies, then which invest into the equities, real estate funds and different type of financial instruments on behalf of the customer, right, on behalf of the investor, then they makes money for you. So they will not do free regarding the your investment. They will take certain charge regarding the for the management of your fund is concerned. So the mutual funds which comes through a NAVs, net asset values. So by using that net asset values, you will in case of you have demat account, those net asset values will be credited in a dematerialized form into your DP account, or you don't have, those will be there in the physical form. So again, to the particular fund you may invest by using systematic investment plan. So whatever the net asset value is there, so you can buy monthly or quarterly and yearly, whatever you feel good for you. You may invest into the mutual funds, and again the net asset value will be average pricing will be done in the case of you invest systematic investment plan method. So suppose you want to invest 1000 rupees per month. Let's take a one mutual fund, a particular fund. So there are 20 rupees net asset value. You will get how many NAVs? 50 NAVs for your 1000 rupees. Next month similarly that came to 15 rupees. You will get more NAVs compared to the 50 to the last month. So that went up to 25 rupees. Your value which has been gone up, but you will get less NAVs for your 1000 rupees, but it will be averaging. One day once the rise, in case of it depends upon equity market and it depends upon bond market, it depends upon the product where you, which fund you are choosing. So once averaging is done, once your investment which grow up, the lump sum amount you will get, and the higher number of quantity also you will receive by systematic investment plan. Let's take an example. Mr. A, which is investing 1000 rupees per month in the next 12 months in the mutual funds. So he invests 12,000. So in case of the net asset value is 20 rupees. So in the first month, second month 18 rupees, third month 16 rupees, and fourth month 22 rupees. Let's take an average of 25 rupees. He bought the entire for 12 months. So n number of net asset values into his demat account or into his physical form of certificates. Then suppose the net asset value increases to 50 rupees. Then automatically his total number of net asset values will be considered into 50. Then he will get the n number of amount for his SIP investment equal to some lump sum amount he will get by investing into the mutual funds. The third type of investment are the SIPs, which can be made under the exchange traded funds. The exchange traded funds are which trades under the cash market of the NSE, National Stock Exchange. So I will make a separate video what are the exchange traded funds, what are all included on the exchange traded funds. So as of now the NSE is allowing the exchange traded funds into gold market, bond market and international indices and indices of Indian indices. Let's say there is a product called Nifty Bees, and these asset management companies only which registered with the stock exchange, which lists the exchange traded products which continuously as like at the equities which trades in under the cash market of the NSE, right? So there is a liquid base, Bharat bond. There are so many examples. In case of bond means in bond market you will get a specified rate of interest, that is a fixed rate of interest type you will get. But equities and indices products means it is depends upon the market risks, subject to market risks. So once you investing your amount by using SIP method under the exchange traded funds means you will buy some shares, right? Let's take Nifty Bees. Now the present value of Nifty Bees around 125 rupees. So 1000 rupees you want to invest, hardly you will get 7 Nifty Bees shares. So the indices is different and exchange traded fund is different, but you now Nifty present rate is 12,000. You cannot buy entire 12,000, but the one Nifty base which is trading at 125 rupees, you can buy one Nifty base. It reflects the Nifty base which reflects the Nifty, right? The Sensex base which reflects the Sensex. The indices product, this is the indices product which will reflect the particular indices, but no need to buy the entire Nifty or entire Sensex or entire Bank Nifty. So which will be divided. So the divided product you can buy in the cash market of the NSE by using exchange traded fund. So there are various types of exchange traded funds. I will make a separate video in relating to the exchange traded fund and different products, different instruments available under the exchange traded fund is concerned. So in overall, in case we see the systematic investment plan or planning means, it is advantageous in comparison to the lump sum investment, which I can say your discipline will work here, and you're investing every month, and the quantity will be averaged in the volatile market. So even market is going up, no need to bother. Market is coming down, no need to bother. So you are investing very frequently, your psychology will work, and your investment will give, there will be a huge chance of getting better returns compared to the lump sum investment in the systematic investment planning. So discipline, psychology, right, subject to market risk, you will be forward in the volatile markets, etc. These are the various advantages. So thank you very much. I hope you will enjoy this video.